And thanks for joining us today. This is Climate Risk. Are we headed into an uninsurable future? My name is Megan Morris. I'm the Associate Director of the Sustainable and Impact Finance Initiative here at Haas. So we have a lot of the courses having to do with sustainable finance, and we've organized 3 different sessions for this track. And I'd love to hand it over to our great moderator, Maddie Vaughn, who is with the head of strategy for the Resiliency Company.
Is mine's on? Yeah, okay, great. And you hold that, right? The lab. Hi, everyone. I'm Maddie. I lead strategy for a nonprofit called the Resiliency Company that is mobilizing capital to flow to communities to help build with adaptation to be more resilient to the effects of climate change. I am joined today by an amazing panelist of insurance experts. Kayla Calkins to my left from the Wildfire Resilience Funders Network, or Funders. Allison Wolff here, CEO of Vibrant Planet, and Dave Jones, who's UC Berkeley's Center for Law, Energy, and the Environment, Director of the Climate Risk Initiative, and previously California Insurance Commissioner. We have a great conversation today about how we can ensure a more insurable future for the United States. We're going to set the stage really quickly with a couple of notes on just some stage setting around the current state of climate disasters in the United States. Rising temperatures, extreme weather, flooding events, and other disasters have impacted 90% of counties in the U.S. over the last decade, and insurance is one of the industries that's being just extremely hard hit by this current climate moment we're living in. To frame up sort of the panel flagging that $30 trillion is the total in assets under management by the insurance sector globally, $8.5 trillion of assets under management in the insurance sector in the U.S. alone. We've seen like massive devastation in recent events like the Eaton and Palisades fires that's causing insurers to non-renew policies in different high-risk areas of the United States. And yet a lot of homeowners still don't have insurance. So we know, and we will talk about this in the panel, that every dollar invested in disaster preparation saves $13 in economic costs, damages, and cleanup. And it's sort of this frame and context that we will be thinking about as the backdrop for the panel. So we are going to hop into the discussion, starting with, let's go back to our intro slide here. We're going to start with you, Dave, to see if you can set us up first with an overview of the state of insurance today.
So thank you all for coming. You could have held a panel like this 10 years ago and fired a cannon through it, a panel on insurance. Nobody would attend. Now, a lot of interest. So I think the short version of my introductory remarks is insurance is the climate crisis canary in the coal mine, and the canary is dying. Insurance companies are globally seeing insured nat cat losses rise. Last year, global insured nat cat losses were about $154 billion. In the U.S., about $117 billion. Don't quote me on the exact number. And that was a bigger number than the year before and a bigger number than the year before. It bounces around a little bit, but the trend is up. The trend is up because there are more extreme and severe weather-related events that are landing in various geographies, killing people, injuring people, but also destroying residences and business property and causing larger insurance payouts, particularly in developed economies where there's more proliferation of insurance. Insurers respond in 2 ways to increase losses. They're rational economic actors. They're for-profit enterprises. And the 2 ways in which they respond, usually contemporaneously, is to raise price and to reduce the writing of insurance. Property insurance in this country, and I think it's true in most countries, it's a 1-year contract. It's not like you're putting money into a bank. You're buying a 1-year contract from an insurance company to cover your property and for them to cover up to certain limits in the insurance contract, but you have no legal right to the insurance after that year. And what insurers increasingly are doing, not just in California, but across the United States, is non-renewing 1-year insurance contracts and also declining to write new customers. There's some 18 states in which this is occurring with different levels of acuity. You've probably heard about Florida and Louisiana, huge challenges due to wind and hurricane risk. California, a problem due to wildfire. So we're going to do a deeper dive into what some of the market responses and policy responses are to that. There are 2 other contributing factors to the insurance crisis in the United States, though. The second one is we're shoving more people and businesses into harm's way. So as a consequence, insurers are insuring more properties and businesses in areas where climate change is landing with greater severity and frequency. That causes higher payouts. And also the value of replacing property is going up substantially over the last 10, 15 years. And that causes higher insurance payouts too. Now, the insurers argue that the last two phenomenon are bigger than the climate-driven, more extreme, severe weather-related events phenomenon. But I argue the last two things wouldn't matter as much if we didn't have more extreme and severe weather-related events landing in these areas. So a little bit of an overview with regard to what the industry reaction is and the challenges that then imposes for the real economy. You probably saw that the chair of the Fed the other week testified before Congress that it's his view that some 10 to 15 years from now, there'll be parts of this country where you can't get a mortgage. Why is that? Because every mortgage loan written for residential property in the United States requires you to have insurance. If you can't afford insurance because the price is too high, then you won't be able to get a mortgage. And because insurance prices are going up substantially in various geographies across the United States, the concern is that will be a real impediment, particularly to low and middle income families getting mortgages. So you can see how this sort of effect of climate on insurance, on mortgage lending, and other sectors of the financial industry as well can have ripple effects that then can have tremendous consequences for both the real economy and the financial sector.
Great. Thanks, Dave. Let's pass it over to Kayla and have your read on the same question. What would you add, and how might you describe the state of insurance in the U.S. today?
Yeah, thank you. And I have an insurance background. I was at a big Fortune 50, did some insurtech startups, and then left to go do more of the public sector view on climate adaptation and resilience. So currently I have a bit more of that kind of like community level protection gap. Well, what are we going to do? And I was saying when I left the industry, I was like, insurance as we know it is breaking. And that has felt true and increasingly true. And I think what that means is, and it's what Dave highlighted, is we have a risk problem. So we have to lower risk. And that's Allison will talk about that quite a bit in order for an insurance market or new risk transfer markets to become healthy. Because the insurance market is not particularly healthy here right now. And that's also in other parts of the country as well. We're seeing the costs go up for homeowners all across the board. There was First Street data, which is really great risk data, that just came out recently that said it used to be 7 to 8% of your mortgage cost was insurance, and it's currently 20%. So that's a significant cost to households, right? And that's when it's available. It's not just fires, it's atmospheric rivers and grapefruit-sized hail in the Midwest. So we're seeing these risks grow significantly. And from a kind of public sector standpoint, we're not sure what to do, right, yet. And I think there's a lot of interest in pilots of how can we understand community problems and create new solutions for communities in a way that are sustainable.
Let's pass it over to you, Allison, to talk a little bit about that particular answer. I'll pass you the clicker so you can go through yours. Okay. I can move it forward to your slides. Here we go.
Okay, cool.
Yeah.
Hey, everybody. Thanks for coming. So I'm the CEO of a company called Vibrant Planet that started about 4 years ago to help with wildfire risk mitigation. And so it's a really sophisticated scientific technology platform that has we use machine learning to basically build a foundation model that enables us to map vegetation at a very, very fine scale. And then that vegetation model and fuelscapes models feed into our advanced wildfire modeling. And so we're able to have a kind of a current view of risk across communities, the wild urban interface, so the lands that sit around communities, and then out in wildlands. And in the Western U.S., about 40 to 60% of land management or land ownership is federal. And so we built a system that would actually enable us to help with that very, very giant problem of that very large amount of land across the Western United States. So both Kayla and Dave talked about this a little bit. Basically, at this point, the only path for viable insurance is risk mitigation. There's not a ton we can do about warmer oceans. That's a very, very long time frame to fix that, if we can even, which is causing obviously more severe hurricane weather. We can actually mitigate wildfire risk. So it's one of the climate driven risks that we can actually mitigate, and we have to. So I can't remember if you were commissioner in 2020. Yes. No. So 2020's fires here in California the industry lost 20 years of profitability just in that 1 year from those fires. And so it's a really big problem. And when you think about fire, there's sort of picture a triangle where that determines how severe a fire is going to be. So there's the vegetation structure, how much fuel is in a forest or shrublands, that kind of thing. There's climate and there's weather. And there's clear science that Dave has been part of pioneering with Nature Conservancy and others. If we can make sure that we've got a resilient vegetation structure and an appropriate number of trees per acre. We have a long history with our land in the West where we cut everything down. We played out the Lorax. It grew back too thick. We've been suppressing fire in landscapes that actually need fire to be healthy, to keep a sustainable number of trees per acre, to clean up forest floors or vegetation like shrublands and grasslands around places like Los Angeles. So these systems evolved with fire, and we've stopped fire because we don't like it. And that's biting us in the ass now, basically. So what we have to do is go in to all of these lands and actually get them back into a resilient state historically, but also a future resilient state. And so it's a very, very hard problem. And at this point, we have to prioritize our actions because the problem is so big. So, really quickly, this is the Altadena fire. So the Angeles National Forest abuts you can see where the green is. The fire footprint is that orange line, and you can see where the damage is. So it was it was like paradise. Everything was flattened by that fire, and we saw 400 structures destroyed, another 1,000 damage to the tune of $40 billion in losses. And then if you add the Palisades fire, $75 billion in losses. And then on top of that, we spent tens of millions of dollars, we don't even know the number yet, on fire suppression. And then, of course, after fires, rain comes finally and thankfully, but it's also another added risk. So after fires, you can see these horrific debris flows and landslides that destroys water quality. Morehouse, we saw that with the Thompson fire in the Santa Barbara area. So a lot of folks in the United States and Congress and otherwise think this is a California problem. This is not just a California problem. This is what the West looked like a couple of months ago, and probably even right now because we haven't had any snow or rain, but other than Southern California. So if we just look at the number of communities that have the same risk profile as Altadena had, we're talking 300 communities across the Western United States. And that totals about 580,000 structures, about $435 billion or 1.6% of GDP. I forgot I can look in front of me. And then we also wanted to map, this is a presentation I gave to Congress last week, how many of those towns have exposure from federal lands. And where we have to get after this risk mitigation, again, across communities where we're doing defensible space, we're thinking about roofing materials, do you have a propane tank in your backyard, that kind of thing. But then that wild urban interface where in Altadena, the fire started out in the wild urban interface with vegetation, likely from a utility that I won't name. And then it very quickly moved into the urban area and became an urban conflagration. And that's what we're seeing more and more. And then if you go out even further, this is not just a Western problem. There's a lot of red and orange in the East as well. And that's going to keep getting worse with climate change. So what our system does at Vibrant Planet is we work with our customers by an annual subscription. It's software as a service. And it's an analytics platform that gives them a current view of conditions, current view of wildfire risk across those three zones: communities, wild urban interface, wildlands. And then they can put in, what are the outcomes I'm seeking? Right now, it's all about, asset protection, community safety, being able to evacuate people safely, that kind of thing. But also we have to care about water. We have to care about biodiversity, and we better care about carbon because it's driving this problem too. So the system's really looking across all these values. Forest Service is managing for all those things plus recreation. And so they can put in this multi-layered objective set. how much budget they have, and then it spits out a recommendation of here's where you should prioritize. You only have so much money. Where do you go to get the most bang for the buck? So that's what the system does. So this is the Eat and Fire footprint. And what I'm showing is we just deployed our system, they had not done plans yet with it, and they had not done treatments. If they had, so we basically just used our own system to say, like, what would they likely have done? This is where the treatments would have been. That's where the fire started. And you can see $9 million invested in treatments before the fire would have resulted in avoided losses of $3.1 billion in our modeling, because we would have kept it from that our system, if those treatments had happened, it wouldn't have become an urban conflagration, but it turned into a $39.9 billion ROI. That's pretty good. So we are so good at reacting to disaster. We are really bad at dealing with fundamental resilience building and the issues ahead of the problem. So that just kind of zooms into so this is an animation that shows, again, where there's all those treatments I just showed, that those green blobs, how the fire would have been slowed down and would have pushed away from Altadena. And this is without fire suppression. So this is where you can see firefighters would have been able to get in there and set up a successful operation and get people out more effectively if those treatments happened. So in Southern California, we don't have forests. And so it's a little bit of that story of get people out, set up a successful operation to defend communities. In forested communities like in Placer County, like Truckee, if you guys go up to the Tahoe area, they have the most structures at risk in California. We work with them as well. And that's a lot of like forested communities where they can do a lot more to build resilience. Just one other example, in Flagstaff, Arizona, very, very high danger. This is the likely treatment mix there. We aren't even deployed there yet. And then in terms of ROI, 25 million of treatments, avoided loss projection of those structures, like less structure exposure, less ember cast, less fire intensity, almost $1.4 billion of avoided loss, which is an ROI of 1.3 billion. It's a no-brainer, right? And yet we have such a hard time of convincing people to get ahead of the problem. Just adding a few others up. So these 5 places, Boulder, Colorado, my hometown, burned, if you remember, in December a couple of years ago. So in these 5 places, if we just did treatments here, 76 million invested, avoided loss of 2.85 billion. That's huge. So anyway, just I can talk a little bit about insurance. We're starting to intersect with insurance, as you can imagine. In Incline Village, Nevada, there's been a lot of treatments that have happened, and that has really radically reduced risk there. And so there's a school, you can see in the orange areas, there's a private school whose insurance went from $30,000 a year to $2 million like a couple of months ago. And they're like, we're out, we can't afford that. And so we're getting them underwritten using our fire analytics, and an innovator, maybe Dave or others can talk about some of the emerging innovators in the space, some of whom are partners of ours, to get that school and then an HOA, which actually I used to live in, insured again. They can't get insurance. So that we're starting to see innovation and sort of disruption in insurance. That's kind of going to give some of the big guys a kick in the pants, basically. So. Yeah.
Great. I want to make sure too, in N500, can they hear us? I saw okay, everything's good. Sound effects. I don't probably need it, but yeah, great. Mine, you can hear mine though in there, the lav mic. Oh, I'll use this in case. Okay, great.
Can we just go back to the cover slide or move it?
Yeah, sure. So we can, just for the people who are joining in late, can see who's on the panel. I think exactly what Allison just transitioned us to, talking about, obviously, if we can reduce exposure, reduce risk, there's a lot of really interesting innovation happening in this space. So Dave, I would turn it over to you to talk about that a little bit further and some of the work you've done with Delos and others who are really innovating creatively in this space.
Thank you. So first, I think it's important to understand that notwithstanding all of the empirical evidence that property, community, and landscape scale mitigation of the type that Allison has talked about works, and notwithstanding the fact that the insurer's own research institute has concluded the same, most, if not all, insurance companies writing property and casualty insurance in this country don't account for the risk reduction benefit of mitigation in their models that they use to decide whether to write or renew insurance. And this is not just a California wildfire problem. The same is true with regard to other perils in other geographies. So there's a standard to make your home less likely to blow down in the event of a hurricane. It's called the Fortified Home Standard. It's a standard that's been adopted by Gulf and Atlantic states. States are providing grant funds to homeowners to retrofit their homes to meet the Fortified Home Standard. And yet the direct writers of home insurance in those Gulf and Atlantic states are not taking that into their risk score models for purposes of deciding whether to renew or write insurance for those homes. Now, you can imagine how frustrating that is. So California, for example, has appropriated $3.6 billion for the kind of landscape scale forest and chaparral land treatment that Allison was talking about. Homeowners associations are collecting fees from homeowners. Towns, counties are collecting property taxes to do this work. Individual homeowners are spending thousands of dollars to do property level mitigation, home hardening, defensible space, and yet they get no credit for it in the underwriting models. Now, there has been some progress in terms of pricing. So my successor issued a regulation the other year that requires a discount if you do a home hardening, defensible space, and you're in a fire-wise community. But, of course, the discount doesn't matter if they won't write you the insurance. Right. So this is a big public policy problem. And you might ask yourselves, like, well, wouldn't it be in the economic interest of the insurers just to incorporate this into their risk score models? And the problem is that insurance is not a market share business. It's not like you're producing a widget and you're making 25 cents in each widget, so let's produce a lot more widgets so we can make more money. It's really about writing an insurance product, trying to figure out how to reduce the likelihood that anyone's going to actually make a claim against your insurance product, and then taking those premiums and investing them and making a lot of money on the investing side. So expanding market share in the face of background risk rising due to more extreme and severe weather-related events, wildfire, drought, river flooding, sea level rise, hurricanes, tornadoes. Here's a new one, severe convective storms. Right? If you had asked an insurance professional 25 years ago, you worried about severe convective storms, they would have looked at you and said, what's a severe convective storm, right? Last year, 50% of the insured natural catastrophe losses globally were from, wait for it, severe convective storms, which is the same thing for the year prior, and the same thing in the United States. So what's going on? Global temperatures rising because we're not transitioning fast enough and aggressively enough from fossil fuels and other greenhouse gas emitting industries. Global temperatures rising means that the atmosphere holds more water. Changes in climate patterns means that this water sits over geographies and then comes down as rain for sustained periods, damages property. And it's not even the flood part that's the problem, right? Because the private insurers got out of writing flood insurance in this country 60 years ago. So it's not the losses from flood, it's just the sustained heavy rain contributing to 50% of their insured losses last year. So climate change is not only making the things that have historically killed us worse, it's creating new things to kill us and damage our properties. Okay, now there is a little bit of good news here. Right. Now, one is that insurance is regulated at the state level, and states have the power to require insurance companies to account for mitigation in their underwriting models. So far, no state has done that. We made an effort at this in California last year. The insurers killed it. There's another effort in Colorado. But beyond that, there are new market entrants that are actually incorporating mitigation into their modeling. And full disclosure, I'm on the advisory board of one called Dellis. So Dellis is a group of folks that were satellite engineers and modelers who decided that they could take these two technologies, put together a better model that better incorporated mitigation, and that they could write insurance for those exposures that the major admitted carriers are turning down because their models don't account for mitigation. And so they're doing exactly that, and they're doing it successfully. So that's good news. There are startups and market entrants and efforts like that, which Vibrant Planet is pioneering with regard to trying to take better modeling that accounts for mitigation, get underwriters to use it, and to begin writing insurance. But sadly, that's just a fraction of the market. And it's a very conservative industry, and it's going to take a long time for that path to finally materialize. So my personal view is we need both. We need innovation, we need startups, we need more market entrants, which is where you come in, right? But also we're going to need some regulation too, to try to make sure that insurers are accounting for mitigation in their underwriting models.
Actually, to that point, we are taking questions Q&A through the Wolff app, so feel free to add questions as we're going through. We'll mostly take Q&A at the end, but there's one question that came in that relates to what you were talking about. So the question is, why don't insurers just raise prices instead of cutting off properties from insurance completely? And that's obviously a complicated answer, but I wonder if one of you...
Well, they are. I don't know if any of you have insurance, but they are. They're doing both. And they're going to be doing more of that in California. I mean, rates are going to go up substantially. They have been going up, and they're going to go up even more. Now, there is an argument the insurers make, which goes as follows. Look, if we just got all insurance regulation out of the way and we deregulated insurance markets entirely and we could price whatever we want and didn't have to worry about these pesky reserve requirements and other things, we could solve this problem. The problem with that argument is that there is a real-time example of this, and that's Florida, which has dramatically deregulated its insurance market. Rates are 4 times the national average. They've reduced all barriers to entry such that they now allow a lesser-tier rating agency to rate the insurance companies that want to do business in Florida. I'll tell you how well that's gone. After the last big hurricane, there were 10 insurance insolvencies. They were all rated by Demotech, the lesser-tiered rating agency that Florida is allowing to rate insurance companies. So the argument that we're going to price increase and deregulate our way out of this problem, I think the answer is no. I mean, in the shorter midterm, more pricing will help insurers, and so the rate increases that insurers are going to get here in California will, in the shorter midterm, hopefully get them to start writing again, except now we just had a $35 billion loss experience in L.A., and we'll see whether the regulatory changes that were enacted last year to give them more rate faster will actually result in them writing again, given the losses that they just experienced. So, yes, they are raising price. Yes, raising price is important. No, we shouldn't suppress insurance rate pricing. But what's happening in the background is the background risk is growing and the magnitude of loss is growing. And you have places like Florida that have deregulated. And notwithstanding that, no national carrier is writing in Florida. Why? Because even at the highest price, even with the lowest regulations, all the national carriers have concluded Florida's a losing bet.
So this next question, I'm going to direct Kayla to you to start with. We talked a lot about the mitigation efforts that can happen to reduce risk in communities for specific homeowners. There's also a lot that exists here in terms of herd immunity and how a community thinks about their overall sort of collective resilience. I'm wondering if you can talk about some of the solutions and innovations you're seeing in that regard, whether it's with parametric insurance or some of the models that you've seen successful there.
Yeah, and Allison kind of mentioned this. It's like with flood, it's different. If you mitigate your home against flood, you put your home up on stilts, your home will be okay. It doesn't matter that the homes around you didn't put their houses on stilts, right? But with wildfire, everybody kind of has to do it, because if you did your house as well as you could, but your neighbor has a wood fence and it's just on the other side of 10 feet, there's risk there, right? So there's that piece of like, we need, and I find this really beautiful and inspiring actually. And I'm like a disaster girl, so clearly you have to find some inspiration somewhere. But it's like, we have to connect more deeply. When disasters happen, you only have each other. So connecting at the community level and finding reasons to kind of like rise up and say like, we are going to do this. We are going to work with entrants that are doing different things. We want new solutions and we're going to find them together. I think is a really like potentially positive, part of this. There are many communities that do not have the means to do that. I think this is a good time to mention the protection gap in the United States of America, which is 42%. So 42% of losses go uninsured post-catastrophic event. That is $480 billion between 2013 and 2024. That's a lot of money. And so where does that go, right? It's federal aid, state grants. If you have savings, theoretically savings, but those economic losses add up to impacts to our communities, right? And if you can't afford insurance in the first place, which is ultimately financial resilience. Like when we talk about insurance, it's your ability to withstand and recover when really bad things happen. It is a critical economic tool, and without it, our markets will be at risk, and our communities will be at risk. So this is big systems level stuff, right? I never thought I was going to spend a career like nerding out on this, and I was just like, this is such a critical problem. It's only getting worse. Okay, so interesting, solutions. Parametric insurance. Has anybody heard of parametric insurance? Okay, cool. So indemnity insurance is what we traditionally think about when we think of homeowners insurance. That is, you buy a policy with specific coverage. If something happens, you submit a claim, and there's a bunch of people that work in that process to make sure they figure out exactly what you should be paid for, and you should be made whole again. So you should get back to your past state. Parametric insurance is a different type of policy that is an index-based policy that triggers based on a specific measure of an event. So this has been used internationally quite a bit. A good example is like rural farmers for agriculture. And it's kind of a bridge. It's not meant to replace indemnity coverage, but it can help with economic impacts that are not covered by that policy. Business interruption is the example that I use. So say a farmer, it's flood. There's risk of flood. A specific amount of rainfall is identified. There's a specific amount that will be paid if that rain falls at that amount. Essentially, all that has to be done is that the farmer says, yep, it rained and it hurt I'm hurt by this, and great, here's your money. And it can happen really, really fast. So the payout is immediate. It's one amount. There's not a lot of overhead in the process. It's very technology driven. It's really critical to have very specific data that says that this event did happen indeed, and that you pay the right amount based on that, right? So it hasn't caught on quite as much in the U.S. yet, but it is increasingly, I think, of interest because these policies can be written for really specific things. So Raincoat's an example of that. They started out of Puerto Rico after Hurricane Maria. Kettle is doing some things in that space for wildfire in particular. Those are both insurtechs. And then I'm less familiar with Rock Rose, but I know that you both are. They have some interesting things that they're looking at that I've just heard of recently. They're stealth right now. So I guess
who we're working with.
so you can maybe talk more about it. Do you want to talk about Rock Rose?
Well, they're an innovative broker. Basically, it's the people from Kettle. So Kettle started as a wildfire reinsurer, and then Rock Rose is brokering insurance based on risk analytics, and so that's where we're working with them in that Incline Village slide that I showed, and also with 2 Napa Valley wineries. And so they can shop around a well-priced insurance package to the industry and get it underwritten based on better analytics, basically. Yeah. So, and I wanted to just add to what you were saying on so much of this is, and where technology plays really, really well is it's a lot of it is communication problem. And so the herd immunity idea, because of wildland to structure and then structure to structure fire, you really are dependent on your neighbors to do their part. And the way to motivate that is to show pictures. I mean, we looked at a timestamp on Google Street Map, took a picture of several views of homes in Altadena, and all those homes had vines crawling up their walls. They had great big junipers, one of the most fire-prone species. Great big junipers, shaped into little animals and big squares and things. And then there's also an issue with building codes where California has really stringent fire resilient building codes, but there's a big grandfathering in of older homes. I forget what year it is. David, no. 2008. And so there's a lot of 70s homes with wood decks and, shake roofs and things like that. And so the concept of herd immunity, like we have with vaccines, it really does play with fire. And that's a social problem, right? Where we all are dependent on each other to do our part.
Yeah. You can hold on to that. I think my mic is working now. Yeah. Okay, great. So there's a lot here about the economics of the current problem, how this might affect mortgages, affordable housing, other pieces of our economy. And there's a question that came in, given that the state of the insurer of last resort, or given the current state of the insurer of last resort, and that might be a good thing to speak to first with the California FAIR Plan. The question is, could escalating climate-related insurance claims create systemic financial instability comparable to the 2008 crisis? So I think it would be great to just talk about sort of the economic implications of our current environment.
So the insurer of last resort is the FAIR Plan. It's also referred to as a residual market. So interestingly, 35 states have fair plans. They write insurance for the exposures that the private insurers won't cover. And they were first established in the 60s during the period of urban unrest in the United States, when private insurers decided that they didn't want to write insurance for urban inner city areas anymore because of the potential for urban unrest and fires. And so the federal government stood up a riot insurance program, literally was called that, and basically said, look, we, the federal government, will backstop states setting up residual markets or fair plans that will write insurance in urban areas where the private insurers are pulling out. Well, that federal law has long since expired, but these fair plans have persisted to this day. And what they've evolved to is writing the perils or risks that the private insurers won't write, largely driven by these extreme and severe weather-related events. The structure of the fair plan is it's not a government agency. It's not taxpayer funded. It's, wait for it, a state statutorily created involuntary association of the private insurance companies. So the state passes a law and says, look, for the privilege of writing insurance in our state and for the privilege of deciding who you're going to write insurance for, you're going to join this thing called the Fair Plan, and that's going to write insurance for the stuff that you won't write. Now, because the Fair Plans are writing the riskiest exposures, the Fair Plan rates in the 35 states that have them are going to be high, right? Because they're not spreading the risk across a wide number of varying exposures facing different degrees of risk. They've got all the stuff the private insurance industry decided they're not going to write insurance for at any price. So what states have also decided, I'm paraphrasing, is that they're not going to require the fair plans to have the same level of reserves as a private insurance company. Because if they did that, nobody could afford a fair plan insurance policy. So instead, fair plans have to have enough money to cover a typical year. But if they have a catastrophic year, like, for example, this year in California, well, then the usual rule was that the fair plan would then assess all of the insurance companies in the market based on their market share. So there's some rough justice, right? It's the insurance companies that are deciding, based on their not writing insurance, how many people are going to be in the fair plan. If the fair plan runs out of money, then the fair plan is going to go to the private insurers to make sure that it has enough money to pay claims. Well, that was the rule in California until last year, when a new order was issued at the request of the insurers, who don't like having that exposure on their balance sheet of the fair plan shortfall. And they've seen California's fair plan policy count go from 180,000 when I left office on January 4th, 2019 to about 455,000 now. And the policy count's only going up because they're writing less insurance. So they got an order issued that limits their exposure to a fair plan shortfall to $500 million. Guess who's on the hook for the rest of it if the fair plan runs out of more than $500 million of claims paying capacity?
Taxpayer.
Us, right? Well, those of us that have property insurance, right?
Very motivating to buy a house. Huh?
Yeah, right.
Well, and this is indeed a problem, right? So the fair plan, no surprise, ran out of money in the wake of the LA wildfires, asked for $1 billion. The commissioner approved they're getting $500 million from the insurers collectively. The next $500 million the insurers are going to pass through to all the rest of us, on top of the rate increases we're going to be getting already because the risk is going up and the insurer's losses are going up. And it's an interesting question whether the fair plan is going to need more, right? They've made some reasonable assumptions about how much they need, what the relative share and mix of the claims is that they're getting, but they could need more, in which case they're going to have to go to all of us for more. The good news is that if you have a fair plan insurance policy, your claim will be paid. Right. So at least what this structure does provide for is that the fair plan technically can't go insolvent. It will always be able to pay claims, and it'll always be there to provide insurance for those that can't otherwise get insurance. But what it does mean is that we're going to see more people pushed onto fair plans across the United States. And in my view, then, what we need to do is figure out ways to shore up fair plans. And one way to do that would be with a federal reinsurance program of lower cost reinsurance for fair plans. Fair plans have to buy reinsurance like every insurance company. It's super expensive for them. Lower the cost of that by having a federal reinsurance program of basically nonprofit reinsurance for fair plans. Second, the distributional consequences of what happen here are terrible. The people that are most impacted by the rise in price of insurance or the lack of availability of insurance are lower income and low middle income households, right? And already we're seeing some evidence that mortgage defaults are going up in areas where insurance pricing is going up. Why? Because to have a mortgage, you have to have insurance, and if the insurance price goes up and you can't afford it, and you drop your insurance, you lose your mortgage. So what we're looking at is a potential future where increasing numbers of low-income households, if they have a house, may lose it because they can't afford their mortgage. But new households forming, or young people trying to get into the housing market, or anybody trying to get in the housing market for the first time, may find it impossible to do so because they can't afford the insurance that needs to accompany the mortgage that they need to buy the house. So what do we do about that? So we can actually learn from what we did with the Affordable Care Act, where we set up health benefit exchanges across the United States in which insurance was sold. It was priced at whatever the risk-rated price was going to be of the health insurance, but the federal government created a premium subsidy for purchasers of health insurance, lower income, on a sliding scale basis in the health benefits exchanges. The federal government could establish, or a state could establish, a premium subsidy program for lower income households on a sliding scale basis buying insurance on the FAIR plan as a way of trying to help those in the worst circumstance and help lower income households afford insurance and help them, potentially then to be able to afford to have a mortgage and purchase a home. So those are some of the policy interventions I think we're going to need. One last note. There are also a lot of calls for a national all-disaster, all-risk insurance program, right? Let's just get the private market out of the way and create a massive national program of property and casualty insurance. I think that's a bad idea. I think that first of all, I think there's a lot of value in having a private market and private market insurance being provided. I also think our experience with these national insurance schemes has not been good, whether it's the federal crop insurance program or the national flood insurance program. They tend to be very regressive. So if you are a homeowner buying flood insurance in this country, the politicians are unable to require that flood insurance product to be risk rated. It's basically subsidized. Every 10 years or so, Congress has to shovel $15 or $20 billion into the program because it doesn't have enough money. But guess what? The 45% of Americans that are renters are paying through their federal taxes to subsidize federal flood insurance for homeowners. That doesn't make sense. Then the fact that it's not properly risk rated sends the wrong signal. So we're basically encouraging more real estate development in floodplains because we're providing subsidized flood insurance. So this is a partial list. We don't have enough time for the complete list. But I think these national schemes are very problematic. So my personal view is shore up what we've got, which is the FAIR plans, but not try to supplant the private market with some national scheme of insurance, because I think that could go bad in a number of ways.
You all talked a little bit in this about the role of insurance versus reinsurance, and then cat bonds were mentioned too. There have been, for folks who may not understand sort of the difference between insurance and reinsurance, some questions have come through. Can you talk a little bit about the role of reinsurance in all of this? And Dave, you mentioned that a teeny bit, but it'd be great, I think, to go a little bit deeper into that briefly, and then also catastrophe bonds and the role that they play in the space. Allison's passing the mic to Kayla. Do you want to take
I'll do reinsurance briefly.
Okay, great.
Dave can do cat bonds. Dave's
I know a lot about
much more advanced.
Yeah. Good thing that's today's topic.
So reinsurers are the insurance companies' insurance companies, right? And that makes sense because these insurance companies are carrying massive amounts of premium and potential claims that they have to pay out. So what if they can't pay out all those claims? So this is like Lloyd's of London type stuff, right? So you may have heard of Munich Re or Swiss Re. The reinsurers have known about the climate problem for a very, very long time. Their modeling is incredible to look at what potential risk exists, right? Because if their book of business, their insurers are exposed to this potential increasing risk, they're going to want to know about it for their own business. This is, I'll let you expand. I usually talk about these things at a really high level and let folks like Dave go in depth. But the cost to insurers and part of what's getting passed on to customers is the cost of reinsurance. So reinsurers have been raising their rates for the insurance companies, and that is one, in addition to building costs and the things that Dave mentioned, that's part of it.
So I'll just provide a high-level overview of cat bonds. So it's a kind of reinsurance. So basically, the insurer, say, or the FAIR plan will sell a catastrophe bond as a way of raising capital so they have money available to pay claims. They're, paying interest on the catastrophe bond for the right of borrowing money from the capital market to include in their sort of capital and reserve stock to pay future claims. the investors in the cat bond, the purchase of the cat bond, are essentially betting that the catastrophe won't occur, that they'll get paid interest over time, and then they'll get their principal back. If the catastrophe does occur and triggers the cat bond, they don't get their principal back, right? So, this is an emerging instrument. It's a market that's growing, but it has some limitations because there's some substantial risk, and it's oftentimes very sophisticated providers of capital, investors that are doing these things because there's some substantial exposure that, in fact, you won't see your principal come back.
Do you want to? Yeah. Okay. I think we'll move on to another question. Folks have asked, what are some of the effective building or retrofitting techniques that you all have seen that you view as the most effective for climate resilience? And understanding maybe some of the different techniques specific to unique disaster types. Do anyone want to speak? Allison, you might have the most.
Yeah, I can talk a little bit, and then maybe you can add. So a lot of the codes are around actual materials. So I mentioned shake roofs on older homes. So there's modern roofing material that is much more fire resilient. The vegetation around homes having setback ideally of 100 feet away from your home, but in many places, obviously, there's not that much room. And so at least a 5-foot setback instead of having things grow up the side of your house. So things like wood decks. So it's really thinking about construction. And then also, like, we're starting to intersect with so there's one of the innovative MGA insurers, the managed agents that are coming in like Delos. Called MSI, Millennial something. They hold the most policies for new developers and builders. And they're talking to us a lot about, like, if we scooch this neighborhood over a half a mile, do you think that would be a little better? And we're like, yeah, there's a little wind, little canyon here that's a problem for both that fire risk, where fire is like water, right? It'll find the path in, and then the water comes, like we showed in the Eaton fire. So, so it is getting really interesting just thinking about land use. Where can you actually design new communities with natural fire breaks? And then what do you build with? And one of the things that is really interesting is so I talked about with forests, we have overstocked forests. So I'm betting a lot of you go up to the Tahoe area. The Tahoe area has 2 to 10 times the number of trees that used to be there historically before Europeans moved west. That's hard to get your head around. So we go up to Tahoe and we see these thick, beautiful forests. They are totally unnatural. John Muir talked about riding 3 horses wide through the Sierras forests. So they're totally screwed up. You can't even walk into a forest off of I-80 now. They're so overgrown and they're really sick. And that's, again, a history of fire suppression. And before that, cutting everything down and then not managing it either. And so, we know how to get to resilience. It's just it's a ton of work to get there, but it is possible. Anyway, do you want to add anything?
Well, I'd love to hear from Kayla. I might actually extend the question to you one more moment, Allison, of just like, who are the stakeholders involved in that kind of work? That was another curiosity that came from the audience. You mentioned a lot of these innovations, interventions, the forest management. Who is involved in making those decisions, financing it, and then actually implementing these interventions?
Yeah, and I actually had a thought that I just lost, but let me go back to that. So part of what talking about the forest problem, there's a lot of really cool wood utilization industries, and one of the building materials that I'm most excited about is building with wood. So there's a modular wood product called cross-laminated timber, or there's laminated wood timber. And these are like building blocks, like Legos, that are prefab, and it can use, crappy little wood like we see off of I-80, laminated together into these very, very ironically fire resilient modules that get snapped together. And they're also so then you've got embodied carbon in a building that is also extremely fire resilient because it's so tightly laminated that it doesn't burn. And then they're also low operable carbon because of that, because they're so tightly designed. And so I said, like, after Paradise burned, we started our company after Paradise, California burned. And I was like, it would be so righteous if we rebuilt Paradise with wood. And I even saw, like back then, I was starting to really dig into the biomass market side, and the cement and steel industry were so worried about CLT, is the acronym for cross-laminated timber. They were taking out ads in trade magazines with like baby dolls melted in fire because they were so afraid of this new wood building product. And actually, steel and concrete buildings burn much, much more severely than cross-laminated timber. So there's a lot of cool innovation. And so that's like this holistic circular solution where we can get some of the overgrown forested wood, the biomass out of forests, get back to a resilient forest state in places like Truckee, right? And then we're building fire resilient buildings all at the same time. And so it's going to come down to, new actors coming in with innovative companies, building codes, and then training architects, and building codes happen at the very, very local municipal level. There's a lot of education to train up architects, like, hey, did you think about cross-laminated timber as a material, and making sure that you're lobbying for new building codes, and then you've got these big industries going against you. And then there's just the herd immunity point of like each homeowner. HOAs are really important in this problem. And then, counties and fire districts and CAL FIRE here in California, educating, doing house level inspections, all of that is really important. It's a lot of work.
Yeah. Actually, to the architect piece, there's a really interesting, have you all heard about the Slack group that popped up after the Eaton and Palisades fires in Los Angeles? There's a Slack group of 500 to 600 architects in the Los Angeles area who've all come together to start talking about what are these, you did see that, yeah, which is really interesting, just sort of, I don't know, industry move.
And there's talk, I won't name names, but there's talk of like, there is a question we have to ask. We always like, we're going to rebuild. There are places we should not rebuild. And some of the SoCal areas are some of those. And there is talk of like, could we raise enough money to buy that land, turn it into state park land, and just take it off the docket? Like, no one's building here anymore. And there's a lot of places like that. And we have to ask that question. We just love our, that's I wouldn't call that resilience. It's a little bit of stupidity. It's really hard to say that, right? Because we love our homes and our backyards, but.
Yeah, we were talking about that earlier. Kayla, you want to?
Yeah, that's what I was like, and then there's the human component of all this, which is like humans are innately bad at understanding risk, and they also like love what they love, and they love it deeply. And place is one of those things. Like your home, that tree that you planted when your dog died 20 years ago in your yard that's right up against your house, it's dangerous. Like these things are not things that people are willing to give up. And there's this whole, you're totally right. My like logical side is like, we can't keep building in many places. And yet we have housing shortages. The Eaton, I was actually at the Eaton fire site last week touring with firefighters, which was just an incredibly sobering experience. And there's developers already coming in and folks that, their insurance is not going to cover what their rebuild is, and their property values are so much higher. And there's all this predatory stuff that's like, let's get them out of there. National Parks idea sounds nicer. But it's like people need housing, and there's just so many intersecting challenges around these things, and community planning in advance of disasters to decide if we are in a high risk area, and if and when things come, because that is how I talk about the disasters, they will come. Like, let's think ahead so it's not after the fact, because after the fact, people just want back what they had before.
Yeah, or worse. I heard, Dave can maybe correct me if he knows more about this. I heard that in the from some insurance industry folks that in Santa Rosa, if you remember the Tubbs fire that burned through Santa Rosa, when was that? 4 years ago?
2017.
People built defensible space, right, and bigger spacing between homes and vegetation. People got their insurance payout in Santa Rosa, and they built bigger footprint homes. So all the homes in Santa Rosa are closer together, which is not fire resilient. That's such a statement of how humans operate, right? Like, ooh, okay, I'm going to go bigger then. So anyway, it really is like systems change and understanding risk and living differently. And we really, part of our whole shtick is we chose to live in fire-adapted ecosystems. The entire Western United States and 53% of land on Earth, think of Mediterranean Europe, Chile, South Africa, and much of Africa. All of those are ecosystems that evolved with fire. So fire's been rolling through here. We didn't have planes with red retardant until recently, right? Fire rolled through all for thousands of years, and then we had Native Americans that were actively burning land, we think because they were trying to clear brush so they could hunt more effectively. So these systems want fire, and pine cones are round and covered in flammable sap because they want to catch fire, and then they roll around and clean up the forest floor so that the seeds can then get into the dirt faster. Like the whole system's evolved for fire, and we've stopped it. And we've chosen to live in it, and more of us, including myself, live in the woods. And so then we put fires out. And so it's created this self-reinforcing spiral that we are living now. And then you add climate change to the mix, and the sand is moving under our feet. So we can't even use models. I mean, a lot of the industry has been using history to predict future. It doesn't work anymore. And so the modeling space that we live in at Vibrant Planet, and many others, Delos and included, and others, it's trying to figure out this literally shifting landscape that's shifting faster. We're all seeing the science than anyone ever thought it would on climate change.
Yeah. We have 5 official minutes left. So one of the questions I want to make sure we answer with a room full of MBAs is, what does all of the conversation we've had today in this space mean for possible career pathways for folks in the room, and things that you would advise this audience in particular to be thinking about coming out of the MBA programs that they're in?
Don't buy a house. No, I'm just kidding.
Whoops.
I mean, there's job security and adaptation and mitigation, because it's not going to stop. However, we have not figured out great mechanisms to finance adaptation work, right? Mm-hmm. Like, look at the energy transition when it was thriving. And how much growth potential there was there, right? Like, it was like, their businesses were entering startups left and right because there was so much potential growth from a market standpoint. But when you're trying to avoid future economic losses by investing up front like that, every $1 in preparedness saves $13 in economic losses, it just doesn't seem like it makes as much business sense. So I have no doubt your creative minds will find ways to help communities adapt in non-predatory ways. And truly, I mean, remember the least of us, right? It's always those that will be hurt the most that will experience the effects of this stuff the fastest. But the reality is all of us will. So, I don't know, this is it. How is this conference? Is it all dim? Is it all this hard? Yeah. I don't know. There is hope. I mean, there's we got work to do. So there will be new opportunities, and find ways to stay inspired.
Yeah, I mean, the good news is on fire is again, the risk can be mitigated. And so I do agree, jobs in the risk mitigation adaptation fields are definitely where it's at. And new innovations like Delos and Kettle and Rockrose Risk and others, MSI, that's a good place to look. And, I think innovative finance, the Blue Forest Conservation is a partner of ours that does innovative conservation finance, super critical role in the sector that we're in, for watershed and landscape resilience. So there's some really cool stuff going on in that space.
We need smart MBAs in the insurance industry too. I agree with everything that's been said. I mean, we need talented MBAs to work on the transition. So, working in real economy corporates to find ways to make sure that they continue to be profitable, but also reduce their emissions and their footprint, develop new technologies that help us capture, sequester carbon. We need MBAs in the insurance industry to help the insurance industry figure out how better to transition. We need MBAs engaging in the startup space, coming up with new innovations that can help insurers address these issues and these risks and challenges, and develop new models for financing and new models for insurance. So across the board, there's opportunity, and we need you.
Yeah.
I have to say one more thing just because I have to, which I can get in trouble for because I'm working very closely with the Trump administration right now. But I would encourage all of us need to vote for leaders at the local, state, and federal level that are going to get a price on carbon passed. The Uber answer we have to get a price on carbon, and we have to have a functioning carbon market, because that is the only way we're really going to get to resilience, is by actually accounting for carbon impacts and the climate impacts that we're experiencing now, financially and otherwise. And so it comes down to voting. I mean, it really does, who you vote for at these different levels. And unfortunately, we're in an era now where the Inflation Reduction Act is probably going away, which was the biggest catapult we had on EV infrastructure, EV incentives, renewable energy. Wind just got wiped out, right? Like, this is not the time. And it's silly from a business perspective. China's leading, right? Like, it's not good for global policy either. So anyway, I mean, with a room full of young people, you got to vote for people that are pro climate, regardless of what your politics are, I think.
Can I take the clicker? We'll move just the very last slide, and I think we're at time, but there were a couple of resources that you all mentioned on our prep call, and so I pulled them together into a slide to leave everyone with. But are there any other last resources you would leave this room with for folks to think about as they go into the world?
What's your final thought? You were here a couple years ago.
Yeah, I was. So I got my MBA from Haas in 2021, and I got a job, and I'm doing really interesting work, and you all will too. So thank you, everyone, for your time, and thank you, Megan, and the team here for bringing us together for this conversation.